The Fed meets next week with markets betting on another rate cut, and the debate over whether policymakers will follow up with more easing later this year is growing. Mixed data, shifting signals from Jerome Powell, and cautious remarks from Fed officials are keeping the market on edge. Joining us to break it all down is Kathryn Rooney Vera, Chief Market Strategist at StoneX. Thank you for joining us, Kathryn.
Thanks, Fiona.
So, Kathryn, what will the Fed do next week, and what should we expect?
Well, the Fed will likely cut by 25 basis points next week. That'll lower the policy rate to just under 4%. Still historically high, but definitely coming off of the highest bounds that we've seen in recent years. Markets have fully priced this in, Fiona. Everyone's expecting it. The Fed hasn't pushed back on market expectations, so more likely than not, they're going to deliver. The focus, in my view, is now on Jerome Powell's messaging. Chris Waller, Lori Logan, they've both stressed caution, making it clear that policy will depend on incoming data, and this isn't a clear sort of let's cut rates and be done with it. It's going to be a cautious approach. Financial conditions are already loose. Equity markets are very close, or not, if not today, at all-time record highs. So you want to be cautious cutting into an environment like that. And Powell is not willing to accelerate easing into an economy that has all of the above characteristics I just mentioned, as well as still being expanding. And Fiona, expanding above potential growth rates, which in and of itself is inherently inflationary. So we shouldn't discard a hawkish cut. That means a rate cut paired with language that signals caution and restraint going forward.
And how are the markets actually positioning?
They're far ahead of the Fed. So far ahead of the Fed that I think it opens up opportunities for investors. Futures are implying a better than 90% chance of another cut in December. So fully priced for next week and then fully priced for December. That confidence, in my view, looks dubious, let's call it. Equity markets have rallied very, very strongly since August, because traders are betting on this big, full easing cycle. Liquidity is enormous. Valuations are stretched. And if the Fed keeps cutting into this type of environment, the Fed risks fueling asset inflation instead of strengthening the real economy. So in my view, the central question is whether Powell can deliver support without creating another leg up in this asset boom, which is inflationary.
And who actually benefits when the Fed cuts rates?
I've been looking at this very closely, Fiona. I've been looking at generational wealth and the disproportionate benefits by cohort of the society. I think it's very important. I don't think it gets enough attention. It's something I care about. Monetary policy reshapes the distribution of wealth and income. Baby boomers, they hold more than half of all US household wealth. We're talking about $80 trillion. Gen X, about a quarter. Millennials and Gen Z together, less than 10% of all wealth. So when the Fed lowers rates or increases, juices liquidity, it lifts asset prices. And who benefits? Those who hold the assets. Okay. So stocks, housing, bonds, this disproportionately benefits the older asset-rich households and younger generations. And I think we're seeing that in the levels of discontent and protests. And, we see this politically. Younger generations depend more on wages than investment income, so they receive far fewer benefits from the Fed's policy. And I think this deepens the generational divide and disenfranchises the younger people and the lower income people. And I think you're seeing that play out on the streets, quite frankly.
And why does this matter then for the Fed and for the markets?
I think it matters for the Fed, for the markets, and also for policymaking and governability. So inequality influences growth, policy effectiveness, and who's in charge. When policy lifts asset values more than wages, so when prices go up because, policymakers are maybe inadvertently juicing the markets, the benefits concentrate among the existing wealth. Consumption growth slows, economic mobility declines, housing is completely unaffordable for the young people. So each new round of stimulus generates less real activity and, in my view, increasing levels of discontent in society. So since 2008, for example, ultra low rates, which they've been very, very low for an extended period of time, and quantitative easing have boosted market valuations while leaving the younger workers further behind. So this affects the labor market, labor mobility, as I said, and continued easing without structural reform risks kind of repeating the cycle. So the Fed's tools can stabilize demand, but they cannot fix distributional problems created by decades of uneven asset accumulation.
Yeah, some really interesting points there, Kathryn. And I guess now just fixing back to next week, what matters most about next week?
So I think the messaging, Powell's going to deliver 25 basis point cuts. It would be surprising if he didn't, but he's going to emphasize again ad nauseum data dependence and balance. The Fed has to support growth without reigniting or juicing the markets even further or widening inequality. Policy, I think, should encourage productive investment rather than speculative excess, which is what I'm focused on. So for investors, opportunities, I think, are there, but we don't want to chase this market. So I like the real economy needs, energy infrastructure. We are so deficient on this, especially with the AI boom. I like looking at energy infrastructure, nuclear supply chains, critical materials like rare earths. These areas channel capital into productivity, not just price appreciation, which I think we're getting kind of long in the tooth. So that's where monetary policy, in my view, and long-term economic health meet.
Well, thank you again for your analysis. Great to catch up again, Kathryn.
My pleasure. Thank you.
For more videos like this, please do like and subscribe.